All right. Good morning.
Good morning. Aloha.
Aloha. Hey, thanks for taking your time to spend some time with us. We know time is a valuable, non-renewable resource. And so we're going to give you some tips and pointers, and hopefully you're going to find this to be very valuable. I'm going to share my screen right now, he said confidently. So today's topic is going to be building wealth through a 1031 exchange. And we're actually going to talk about using some investment strategies and 1031s as a part of that strategy. This is my partner, Barbara. We've had a successful partnership for over 46 years now, right? Good,
Yep.
Good. Got by that one. And about 46 years ago, I made my first real estate investment. A buddy and I drove up to Lake Tahoe one weekend. We each had $1,000. And with $2,000, we got a loan and we bought a house, a ski cabin at the bottom of Heavenly Valley for $18,000. So that just tells you how long ago that might have been. It was a great place. We rented it out. We used it ourselves, made a little money on it. And 4 years later, things had changed. We decided we were going to sell it. And we sold that for $40,000. We were real estate kings. But if you think about it, we put $2,000 into it, sold it for $40,000, and paid off the mortgage. So that was a good example of leverage. And we're going to talk about using leverage with 1031 exchanges. Later in our lives, when our son went to college in Reno, we bought a house, and it served as a rental property for other students as well. He managed it. We put him on the deed, and a few years later, we sold that, and we bought condos with a 1031 exchange here on Maui. Since he was on the deed, we gave him equity in the house, and he was able to use that to go on to purchase his next home. So that's kind of part of building the legacy, because that's the money that got him started. So today, we're going to take a deep dive into 1031 exchanges, so the mechanics, as well as some other real estate investment tools. We're going to talk about the market, so what's happened in the rearview mirror, what's going on right now. We'll take a little look into the crystal ball to see where we think this market might go. Now, in the intro, I didn't let you know that Barbara is a former CPA. So she worked for one of the big companies. She was also a controller for Apple Computer back in the good old days when Steve and Steve were there. Long time ago. But she's not a CPA anymore, but she's still pretty smart. We're going to go through the mechanics of a 1031 exchange. We're going to talk about buyer contingencies and why those are important to you. And then finally, talk a little bit more about transferring wealth to create a legacy with 1031 exchanges. And then we'll be watching for questions as we travel along the way here. So to get started, what's a 1031 exchange, Barb?
Well, there's an IRS tax code, section 1031. It allows you as an investor to defer the capital gain on the sale of a property that's been an investment property when you purchase a replacement investment property within a specific time frame. So there are very specific rules around this. We always recommend that if you're going to do a 1031 exchange, you definitely talk to your CPA and get their advice.
All right, and you're deferring your capital gains. So what are capital gains?
So this is a relatively simple formula, but again, you're going to need the help of your CPA to come out with the actual numbers. So the selling price is the price that you sell your relinquished property for. And then your closing costs include your title and escrow, your commissions, your accommodator fees, etc. So the difference between that selling price and your closing costs is your net selling price, or what you actually take out of that property. Your cost basis for that property is what you paid for originally, less any depreciation you've taken on your tax returns. So that's your cost basis. And then adding improvements that you've made with receipts gets you down to your adjusted cost basis. So during the time that you've held that property, the improvements are added to the basis. So the difference between the net selling price and the adjusted cost basis that gives you your capital gains. And we have a very simple illustration in this next slide. So if you sold a property for $1 million and your closing costs were $100,000, your net selling price is $900,000. If you purchased that property for $500,000 and made improvements of $100,000, but took depreciation for $200,000, your net adjusted basis for that property would be $400,000. So you actually have a capital gain of $500,000 when you have that transaction with a net selling price of 900 less your adjusted basis of 400,000.
So as you can see, that's a pretty simple formula, but figuring out your depreciation and knowing which improvements you can include, it's probably a good idea to talk to your CPA about that. You know, and the other thing that we talk to people about is they think since their gain was $500,000, that's all they have to reinvest. That's not true, right?
Right.
So you have to reinvest the entire proceeds in order to defer all of the capital gains.
Right.
There are some other things you can do, so we'll talk about that. But the big benefit of doing a 1031 exchange is you don't have to pay the capital gains now, and you can take all of that money, in Barb's example, all of that $1 million and reinvest it into another property. What we've got up here are the capital gains rates for Hawaii, as well as the feds up to 20%. But I'd like to give you an example, and the example comes from a good friend. We'll call him Cousin Joe, because his name is Joe. And in Hawaii, everybody's your cousin or your uncle, it seems like. So what Cousin Joe told me, he's a CPA in California. He's a professor at UC. He teaches classes in advanced accounting, and he also serves as a witness, an expert witness in high-value cases. And I guess the taxes there can come up to as much as 36%. So he said, I had some folks come in, they sold a property, it's already sold. They were going to have about a $10 million gain. Must be nice. And they came in just to find out, how much tax are we going to have to pay? And he said, I give you a choice. You can either pay 0 or you can pay 36%. Which would you like to do? So you know what they chose. They went out in Southern California and went on a buying spree. They were buying residential properties. He tells me they filled up almost the entire $10 million. Not all of it, but almost all of it. So just imagine, you could either pay the government $3.6 million, or you could reinvest that for your future and for your children instead, and pass that along to them. So the great thing about a 1031 exchange is you get to reinvest all of the proceeds. In fact, you have to if you want to defer all the gain. And you don't have to do just property for property. In this case, they sold one property and bought multiple properties. Last year ago, we sold a couple of properties here in Hawaii. My buddy Danny Hara over on Oahu sold a house there. I sold a house here for one fellow. He took the proceeds, reinvested that into multiple homes in Texas, and moved his children there, and eventually he'll be moving there as well. So it can include multiple properties. And back in the old days, when you did an exchange, you had to do things simultaneously. So if I'm trading my ranch for your ranch, it has to happen on the same day. And if they're not the same value, I might have to throw something in. So it's my ranch for your ranch, and I'll throw in a horse to boot. And that's where the term boot came from. So that's additional gain that might be included. We'll touch on that in a little bit as well. So now you really have up to 45 days from closing to identify replacement properties. Barb will explain that, and 180 days to close. So we'll go into a little bit more detail on that. And we'll talk about how a 1031 exchange can be a tool for estate planning. So what qualifies for a 1031 exchange? Like-kind properties, and that is one of the most misunderstood terms in the 1031 exchange world. I've had people come to me and say, Lee, I've got a ranch in Montana. I need to trade that for a ranch in Hawaii. And I tell them no. If you're selling a ranch, you could buy condos, you could buy single family homes, you could buy an apartment building, theater. It's real estate for real estate. You can sell a condo and buy vacant land. You can sell vacant land, which is probably a good idea since you can't depreciate it already, and reinvest that into money-making properties. So it's real estate for real estate. And the exchange can be anywhere in the United States or US territories, except for some reason Puerto Rico, and I don't know why. We also put up a little caution here. When we first started doing this, we were told that related parties could not do 1031 exchanges, a mother and a daughter, for example. We've actually done these with a mother and a daughter. There are special rules that you have to pay attention to. You need to get probably a couple of CPAs involved, some appraisers. It has to be held for a certain amount of time. So they can be done. You just have to make sure you follow all the rules. And then there's some cases where maybe you own a property and live in it, and some of it you use as investment property. And that, Barb, why don't you take
So in a
this one?
case like that, where you live in a property and you're renting part of the property out, lots of people here in Maui have ohanas, so they have their personal residence and then they're renting out their ohana. You can qualify for a partial 1031 exchange if you sell a property like that. So say, just to simplify this example, 50% of your interior floor space is your personal residence, and 50% of your interior floor space is used as a rental. You're renting it out, or even if it's vacant, if you've rented it in the past, you're treating it as an investment property for your taxes, it can qualify for a partial 1031 exchange.
So kind of getting into an example here, if you lived in a place and rented part of it and you decided you wanted to downsize, you could sell the portion that's your personal residence. You get a $250,000 exemption if you're single, $500,000 exemption if you're married. And that's important because
So in a really simplified case that we're showing here, if you have a gain of $1 million and 50% is your personal residence, 50% is an investment property, and you're a married couple, you're both husband and wife are on title, then that first $500,000 qualifies to be tax-free with your exemption, your tax-free exemption as a personal residence sale. The other 50%, it qualifies for a reinvestment or a 1031 exchange, so that you can take that $500,000 and invest it into another investment property and defer your capital gain tax.
so this is a great tool. Like I said, if you're going into retirement, you're downsizing, you want to get out of the big house, buy yourself a condo to live in, buy another condo to rent out to, bring in some extra income, something that you can hand off to the kids.
Yep.
So in this market, there's also a very underutilized tool.
So the reverse 1031 exchange is the opposite of a normal exchange. A normal exchange is where you put your investment property up for sale, you get it into escrow, and then you go out and you buy a replacement property. So the first property closes before the second property. In a market like this market, some people are doing a reverse 1031 exchange. So you can do that. If you find that perfect replacement property that's either in the location you want it to be or has such a good ROI compared to where you are for various reasons, you just found that property, it's a really not a bad idea to buy that property now. It's a seller's market, so it's easier to sell property than it is to buy property right now, to find that replacement property. So if you can do this, it's not a bad idea. It is more complicated. You have to have the ability to buy the property before you sell the other property, which means you either have to have enough cash or be able to qualify to finance that property while you still own the other property. Also, it's more expensive to execute it because in a normal 1031 exchange, your accommodator fees would be around $1,000. In a reverse 1031 exchange, those fees could be 6 to 10 times as much. So you could pay $6,000 or $7,000 for your accommodator. It's more complicated, and they have to take title to that property until both properties close. So it's just more work and more complications. But the market conditions can dictate it as an economic benefit. If it's like right now, it's a tough time for buyers. to find the properties and to be able to get into escrow on those. So if you find that replacement property that you know you want, it's easier to sell your relinquished property because it's a seller's market and there's not enough inventory. So it's less stressful in a market like this when you have to find a replacement property. We also will be talking a little bit about DSTs, Delaware Statutory Trust, which could also be a potential property that you could buy in a reverse 1031 exchange or use in a normal exchange because they're available and they do qualify for 1031 exchange.
Yeah, and the other thing we're doing, because since you have to be able to purchase the replacement property outright,
Right.
and you may need to sell your property to get enough money to do that, so that makes it more difficult. We are seeing some people get home equity lines of credit, either on a personal home, or if you have multiple investments, get lines of credit on those. So then those would be available to buy a replacement property. And so you could buy that and then sell the one that you actually want to sell. So just some additional tools that you can use. And right in here somewhere, somebody usually asks, how long do I have to hold the property before I can exchange it? Well, I asked Cousin Joe, because he's an expert, and Cousin Joe said, Lee, that is a gray question, and gray is an accountant's favorite color. So what I've heard is 2 years. I hear that from a lot of CPAs. From one advisor, they said, well, 2 years, but 2 years could be December 31st of a year and January 1st of the next year. So you need to talk to your CPA to make sure they're comfortable with however you're hoping to go about this.
But the IRS is really going to be looking at the intent when you purchase the property.
Sorry about that.
No, that's just what they're going to be asking about.
Yep, intent is very critical. So
Yes.
be very careful in emails and everything else that you do.
Right.
And so what's new with 1031 exchanges? Well, just to take a few years back, it seems like every administration and every new Congress wants to take a swipe at 1031 exchanges because a lot of taxes get deferred that could otherwise be collected. So back in the Trump administration, 1031 exchanges got hit pretty hard. In the old days, like 4 years ago, you could exchange a lot of different things. Capital equipment, construction equipment would be a good example. Livestock, believe it or not. You could trade a bull for a bull. You could trade a stallion for a stallion, a horse for a horse. You couldn't trade a bull for a cow. Seems wrong. But anyway, 1031 exchanges for real estate were not touched. So that remained intact at that time. So now this year, with the new Biden administration, 1031 exchanges are on the chopping block again. And the proposal that's on the table wouldn't completely eliminate them, but it would limit the amount that you could benefit. The limit that's on the table is $500,000 for an individual, $1 million for joint return, married filing joint return. So that will not affect some people, but if you own property in Hawaii, you could easily have $1 million gain these days. Anything that's over those limits would be ordinary tax. So the rate would go up for those. And the proposed effective date, with effective being the key word, is December 31st. So normally you have 180 days to get closed. But if you did one now, you've got until December 31st of this year. So you want to keep your eye on that. It might be a reason if you're kind of on the fence about doing a 1031, selling something in a seller's market, then this might be a tool for you to use.
So is it a good time to do a 1031 exchange? Well, I think it is a good time. If you have a lot of equity in a property and you want to upgrade or increase your portfolio or increase your return on investment on the properties that you have in your portfolio, or you want to relocate an asset. So for example, you might have $1 million property here in Maui and you want to buy a couple of properties on the mainland that are near your family to invest in, or you can buy some storage that provides a good ROA in Texas, or ROI in Texas. So there's lots of good opportunities to increase your portfolio. And at the same time, the interest rates are historically low. We really won't see these again, and we are all expecting that they'll be going up. So it's a good time from that perspective. And also, if you want to help your family with real estate, as Lee mentioned earlier, you know, we've done that in the past where you buy an investment property. We had our son live there, he paid rent, and that way we were able to help him out and also get leverage and invest that property. It's also a good way to create a financial plan to leave a legacy, and we will talk about that more. So the little caveat with, is it a good time to do a 1031 exchanges? I think that we can help you with this, but you need to have all your ducks in a row. So we'll talk a little bit more about the importance of the timing and the deadlines, and especially in a year like this where 1031 could go away at the end of the year. So
What about the market trends?
it's an interesting market. Interest rates are so low. We've never seen them like this before, and they're going to go up. Of course, everybody knows nationwide, we have very limited inventory. Things are coming on the market, but they're going into escrow. So, you know, we do have to be on top of it and be ready to move when we see something. There are a lot of buyers and they're competing. We're definitely getting multiple offers on properties here that are priced well, or even overpriced. Sometimes we're surprised. We think it's not going to sell for that price, and we end up getting duplicate offers, multiple offers over asking price. So it's a really interesting market. Forecasters are still predicting that prices are going to go up, not as quickly as they have in the last year, but you know, we have low inventory, we have good demand, we have low interest rates. There's no reason for prices to not continue to go up at some level. The market on the mainland, we've heard, is continuing to shift. So where they've had, you know, everything that went to market was getting multiple offers on day one. You know, sometimes it's not, they're not getting an offer for the first couple of weeks. So it has slowed down. You know, obviously one of the reasons for that might be some buyers are just pausing because the prices have gone so high, and some buyers are priced out of the market, especially if they're financing. Their down payments requirements are going up, and they have to be able to cover the difference if the property doesn't appraise for the amount that they are buying it for. So it gets more complicated for buyers right now.
Yeah, and so a lot of people are saying, well, we're going to sit on the sidelines and wait for prices to come down. But the experts that we're looking at, which is a pool of a lot of people through one resource we have, they see that prices will not come down, but after 2023, kind of level into about a 4 to 6% growth rate again, which is a historic norm.
Still pretty good. And like I said, you'll have to work with your realtor to make sure that you know what's going on in the market and be ready and understand what your strategy is going to be.
Yeah, and so just to give you a little historic look before we talk more about interest rates here, and this actually addresses interest rates a little bit. This is a close look at the Maui market. I mean, going back to 2012, which was a pretty strong year for real estate. You know, back then, inventory, we talk about inventory all the time. We had 525 homes on the market in July of that year with 76 sales. So that was a little bit of a market that was in favor of buyers, a little bit buyer leaning. But 5 years later, we still had 530 homes on the market. Sales were up, 88 sales, and we had 6 months of inventory. Now, 6 months is perfectly balanced, right? So neither favors the buyers or the sellers. Last month, there were only 223 homes on the market, and yet we sold 110. So higher than either of those previous snapshots.
It's actually lower than that right now.
It sure is.
Yeah.
So that's a 2-month supply, and the median price has gone from 488 to over $1.1 million in 9 years. So that's the power of appreciation.
Pretty good appreciation.
Right? And condos, it's even more surprising to me. We had 788 back in 2012. Right now, we had 138 on the market when we ran this report. I'm not sure what it is today, but you can see we've been selling 200 condos a month for 4 or 5 straight months now. So the only way you can sell 200 a month when you've only got 138 on the market is new supply is coming in and it's going off very, very quickly. So you've got to be really ready if you're going to be a buyer. And, still, there are good things to buy out there. The median price has more than doubled, so up to 724, and interest rates are down as low as 2.87%. So what Barb said, historically low rates. And this is where somebody would ask, how low are they? So just to look back at the days in the early 80s, Jimmy Carter was president, I think. And I know a lot of folks about our age that bought homes back then at 18, 19%, because that's what we thought it was going to be. And then interest rates came down and down and down. And fortunately, people bought and sold and got lower rates. People refinanced and got lower rates. And now rates are down below 3% again. And so how important is that? Because Barb talked about the idea of selling one place, buying 2 places at lower interest rates. So 2 doors, you've got 2 sources of rent, you've got a little diversification, but how important is that interest rate in terms of buying today? Well, in real estate, we have a thing called the 1% equals 10% rule. And what that means is for every 1%, those interest rates increase. So 3 to 4%, in this case, that's roughly what we have. You lose buying power of roughly 10%. So in the example we have here, somebody's going to buy a $500,000 property. Well, if the interest rate is 2.85% and you put 20% down on the property, your payment's going to be $1,654. So you can calculate what your return on investment is. But if you want to keep your interest or keep your payment at $1,684 and interest rates go up just 1%, now you can only afford to buy a home valued at $441. So you lost $59,000, or in this case, 11% buying power, just because the rate increased a little 1%. If you still wanted to buy the $500,000 home, make that investment, well, your payment goes up $191. So that's money out of your pocket because the interest rate changed. And so Barb also talked about how tight the market is. And there's a little known tool. It's a very underutilized tool called the Delaware Statutory Trust. These have been around for a while, and it sort of looks and feels like stock, but it's really buying a percentage of a trust. And in order to get into this, first you have to be a certified investor. In most cases, that's going to be about $1 million net worth, which if you own real estate here in Hawaii, that could very well be the case, probably is. It is approved by the IRS for an exchange, which is, of course, critical to the conversation. And you're really kind of sitting on the sidelines. You don't have any management problems. It yields a positive return. Right now, what we're hearing is about 3.6 to 4.6 net of fees. That's what's your net in your pocket. You don't have any upfront cost. So if it's part of your 1031 exchange, you just roll your property over to this. You don't need to get a loan, but if you have a loan on your property, that can be rolled in as well, and it becomes a non-recourse loan. So that could be beneficial. Things that investors find particularly attractive, first of all, no management responsibility, no tenants, no trash, no toilets, somebody else's problem. And these properties are institutional quality investments. Some of the examples that are recent are the Amazon warehouse in Georgia, ESPN headquarters, their medical research facilities, so very large properties, storage units, roll-up storage in North Texas. That's my favorite. You have very limited personal liability as opposed to a condo that you own outright. It gives you more diversification. These can be used for estate planning if you don't want to give your kids actual real estate, or if this just works out better. And it eliminates the boot. Remember, you threw in the horse? Well, the boot comes in if you sold, let's say, $1 million property, and your replacement property that you found and you just love is only $800,000. Well, then you've got $200,000 of your exchange left over. That would be exposed to capital gains tax. However, you could take that $200,000, roll it into the Delaware Statutory Trust, and now you've deferred all of the capital gain. Downside to DST is once your money's in, it's in until the property that you're invested in, ESPN headquarters, is sold. And they sell those, they turn over every 4 to 6 years. And when that happens, then your money is available. You can roll it into another DST. You can take it out and invest it into other properties. You can take it out and take the gain. So you have a lot of options. But in this market, some people are feeling like, well, prices are high. Maybe I'll park in a DST until we go into another market cycle. And when that money's available, I'll take it out and look for another property. And as Cousin Joe says, swap till you drop. See? So if you're over 65, you want to keep doing 1031 exchanges because that's going to help your heirs. So in any investment, you should consider your return. How does that work?
So we work with our clients to look at the different ways to gauge the investment whether it's worthwhile or not. The first one is cap rate. That's pretty simple. And you hear this used a lot, especially in commercial property, but we also use it here in Maui looking at short-term rentals, long-term rental properties. So I'll talk a little bit more about that. And then just looking at your return on investment in a couple of different ways. One is cash flow. Cash flow is really important. It's cash is king. And then capital appreciation. We don't like to sell based on expected capital appreciation because nothing is for sure. But if you just look at the way our market has appreciated over those years that we showed on that chart, in 9 years, the prices have more than doubled. So capital appreciation is another way to achieve return on investment, even though we don't sell based on that. So cap rate is a quick gauge to determine the economic viability. So the formula is the annual net operating income divided by your purchase price. Your annual net operating income is your rental income less expenses, not including depreciation. So for example, if you pay $1 million for an investment property and you're getting $50,000 a year in net operating income, then your cap rate on that property is 5%, which would be a really good cap rate for something in Maui.
And one of the most common questions I get is, Lee, will it cash flow? So this question usually comes up with condo tels. So vacation rental property, you want to have a vacation rental property that you can enjoy yourself, like our ski cabin up in Tahoe, and rent it out so it covers all of your expenses or most of your expenses and maybe throw out a little bit of return. So the question is, if I put 20% down, is it going to throw off enough cash to pay my mortgage and taxes and all my other expenses? So when those questions come up, we will typically run a spreadsheet, usually a bit more complicated than this spreadsheet. But what we're really looking to see is if you're only going to put down a certain down payment, will that cover your expenses, or are you going to have to feed it like the alligator? Or will you have enough money thrown off to take care of your expenses? So this very simple example, and I'm not going to go through detail in this, shows you 25%, 30, and 50% down. And the question is, will it cover the expenses? Will it pencil? So with a 25% down, in this case on a $600,000 property at a whopping 5% interest rate, you can tell when we made this slide, does it cash flow? Your net is negative $41 a month. So the answer is no. If you put down 30%, you just bump up your down payment by 5%, $30,000 in this case, $120 a month. So if you've got fixed rent, that works. If you have a condo tel where rent is going to be up and down depending on the season, then some months you're going to have to feed it, and some months you're going to have a nice return. So if you're really conservative, you might want to bump that all the way up to 50% so that you've got a nice smooth cash flow and you don't have to feed it on any of those months. The other thing that Barb talked about is capital appreciation. So when we bought the little cabin in Tahoe and held that for 4 years, most of our money came from capital appreciation. The rent, the cash flow just pretty much took care of the expenses and the mortgage. The thing about capital appreciation is it varies. Our crystal ball doesn't always work that well. And I remember back in 2005, 6, 7, when people were buying properties, and then we had the mortgage crisis. And so the capital appreciation kind of went away. We're not in that situation now. We're not even close to that situation. So we can chat about that offline if you like. But capital appreciation, while it's usually 4 to 6% in any given year, it's hard to calculate. You cannot count on that. If you're buying a property and you want to make sure you have capital appreciation, then you want to look at certain things. We have neighborhoods here, which are going to be important. How old is the neighborhood? Is there an association? How does the association work? If I'm going to rent the property out, what are my rental options? And here, condominiums, usually some of them are so large, they're like their own neighborhood. And so what's the structure? Is it a concrete structure? Is it a wood structure? How much maintenance is that going to require? How well maintained has it been? Has the association been active? Rentability is on here. In Maui, we've had a housing shortage for so long. And right now, our vacation travel is so heavy. If you've got a place, it's probably rentable. But you do want to take into consideration what's the demand going to be, how desirable is the home, the neighborhood, the condominium complex, and who are the kind of tenants that you want to attract. You know, you're looking for long-term tenants, you're looking for somebody that's going to be every 6 months. You know, a lot of people do look for tenants that are going to be 6 months so they can rent their property long-term and then come here and spend 6 months themselves.
Right.
So there's some considerations in there. And Barb, talk about the team.
So it really takes a team to have a successful 1031 exchange process. Of course, we talk about the real estate agents like Lee and I. That's really important because you want to plan ahead. You want to know what your strategy is. You want to be looking at the market where you're selling and the market where you're buying. Sometimes if we're working with someone who's doing an exchange on the mainland, and here we're working with another real estate agent on the mainland, and we look for people that have done 1031 exchanges that understand how to do them. So that's important. Your CPA is really important. You're going to want to make sure that you understand what your capital gain looks like and that they're involved in the process. And an attorney is going to be important if you're doing a purchase in a trust or an LLC, something like that. Escrow company is always involved in every transaction. They're the third party, the neutral third party that handles all of the paperwork and loans and money and things like that. And lender, if you're doing financing, that's going to be really important. And your accommodator is an absolute required part of the team. They're the third party that handles all the money in the exchange. You yourself cannot touch the money in a transaction. If you do, you've failed your exchange and you have a taxable event. So your accommodator is really important. And we get those people involved with our clients early on before we get into the 1031 exchange so that they understand. So the client has an opportunity to ask questions and understand what are the potential complications that they might run into. So.
All right, that's great. So completing a 1031 exchange, the first thing that we spent some time on here now is make sure the numbers allow you to reach your goals. So set what kind of return you want or what your purpose for buying the property is. Maybe it's a condo and you just want it to cover your expenses and you get a place to come and vacation a little bit. When you're selling a property, get the property ready for sale. So we'll talk about some of the little things that you can do to get it ready, but you want to make it look as much like a model home as you can make it look. We want you to be simultaneously searching for finding a replacement property. Easy for me to say. Handle the due diligence carefully. So we want to take a look at the numbers, the associations, if there are some, all of those kinds of things to make sure you're making a good decision. Close on your property that you're selling and defer those capital gains.
And so as we're going through this process, we work with our buyers and our sellers to also prepare them to understand the buyer contingencies in the Hawaii law. And so that you as a seller know what to expect when you're going into escrow, your buyers, the ways that they can get out of the property. And many times right now, especially, we're taking backup offers in case the buyer backs out for whatever reason. And the same thing goes for you as a purchaser of a replacement property. We will let you know, what are your ways to get out of a deal and reasons that you can just go and tie that property up with confidence and make sure that you can do your due diligence. So
yeah, and so as they're getting into this, what are the guidelines?
They're very, very strict. The investor has to designate up to 3 replacement properties within 45 days of closing escrow on that relinquished property. So when I say designate 3 properties, you can't say, I'm going to buy a condo at Kaanapali Shores. You have to specifically identify that particular condo and the TMK number. So it has to be really, really detailed designation. And so during that 45-day period, you can swap properties on that list until the end of that 45 days. And then that's it. You're going to be committed to one of those 3 properties, has to be sold within, has to be purchased within that 180-day period. Then there's also the 208% rule. Lee mentioned the people that have the multi-million-dollar property. When you're selling a large property like that, you're probably going to be looking for multiple replacement properties. So you can identify enough properties on that list to come to 200% of the sale price of that relinquished property. So that's really important, that you know that this is a 45-day hard stop. All of these deadlines are, it doesn't matter if it's a weekend, holiday, etc. When you're looking at these days on the calendar, you need to know exactly when you have to have that done. And so if your 45th day or your 180th day, in the case of closing, falls on a holiday, then you have to be closed before that day. You have to plan ahead. And so the purchase of the replacement property has to be closed within 180 days from closing. So that 180 days includes the 45-day designation period.
Yeah, and if you're working with us, we're going to try to make sure that none of those things start looming and become items of concern. I'll show you exactly how that works in a minute. But the first thing you want to do is get your property ready for sale. Make minor repairs. Oh, so sorry about that. Make minor repairs. So fix those little outlets, touch up the paint, clear the clutter if it's possible to do that. Sometimes you have renters, it's a little harder, but you probably need to get that cleaned up as much as you can. It's a lot easier if the property is vacant, and we would bring in a consultant here maybe to help you do that. If it's a home, make it look nice. Make sure the lawn's mowed, the grass is green, give it good curb appeal. Again, those are fairly inexpensive things to do. And I've said it before, I'll say it again, paint and flooring are magic. They're inexpensive. They hugely change the look of the interior of the property. Updating kitchens and bathrooms in different markets, that can be important. Right now, I wouldn't spend the money to do that just because the market is so hot. If it's vacant, let's get it staged so it looks really sharp. And prepare your income statements. Buyers want to see a P&L. They at least want to see the rental income for the property. So that's one of the first things you as an investor is going to want. You are one. And that's what your buyers are going to want as well. So the 45 days and the 180 days. When we first started doing this, Cousin Joe said, Lee, you got to be careful with those. And so I said, Joe, that's why we have a system. And so our system is very simple, and we're going to be on you. And if you're working with another realtor back in the mainland, you want to make sure that that realtor is on it with you. We would like to start working on these things simultaneously. So help you get your property ready for sale, but we want you to be looking for a replacement property at the same time. We want you to have a sense of the neighborhood, the condo complex, what the prices are doing there, what your alternatives are. And you're only going to know that if you're looking at our website, or you're driving the neighborhoods, or you're looking at Zillow or Redfin or any of those other websites out there. We'd like you to be on ours because we know that you're looking there and we can see what you're seeing. When you get your property listed, you want to have somebody that's going to be aggressive about listing that property and negotiating contracts, managing your timelines right up front before you go into escrow. Those are all going to be critical components to hitting all your timelines. So we do that. We're very careful to explain to you how that gets done. We want you searching for that replacement property, because when you go under contract, which could be pretty quick in this market, we want you to be finding a property and start to make offers. So once you go under contract, which could be 2 or 3 days in this market, because we're going to negotiate the offers, that's why it takes 3 days. You want to start making offers. We would like you to be under contract between the green arrow and the yellow arrow, be under contract on your replacement property. Now, sometimes you'll hear that sellers don't want to take offers that are contingent on the sale of the property you're selling, your relinquished property. If you're doing a 1031 exchange, we are very successful, almost 100%, in getting those offers accepted, because the seller of his property and his or her agent know that the 1031 exchange is in place, and you've got to sell that to avoid or to defer the capital gains. Once you hit this yellow line, then that 45 days that Barbara was talking about, that's when it really starts ticking. So within that 45 days, we want you to be under contract, but that's when you have to pick at least 3 or up to 3 properties, not at least, up to 3 properties. And we would suggest that Delaware Statutory Trust be one of those 3. That way, if everything else goes south, you can still defer the gains. Within that 45 days, we want you to be under contract, and that way you've got the full 180 days, or if the new law goes into effect, until the end of this year, to defer that or to close that property and defer all of your capital gains. And so that's how that works. And the reason that you would want to do this instead of paying taxes or anything else gets back to legacy planning and swap till you drop. So how does that work, Barb?
Okay, so 1031 exchange is a deferral of your tax gain. So if you have a stepped up basis, then the deferral, it changes the nature of the gain, basically. So on the left-hand side of this chart, it shows in a normal circumstance, if the investor pays $50,000 for the property and sells it down the road while they're still alive for $500,000, then they have a capital gains of $450,000 that they have to pay tax on. So if they don't reinvest in a 1031 exchange, they owe that capital gains. However, if they purchase that property at $50,000 and several years down the road, they pass away, the property is worth $300,000 at the date of death, then their heirs inherit that property at a stepped up basis of $300,000. So if the heirs sell the property later on for $500,000, they only owe capital gains tax on the $200,000 gain. So it makes a big difference, and that's why we say swap till you drop.
And so we've had a couple of cases within the last couple of years, actually one just a little bit earlier this year, where a property was held, dad owned the property, and when he passed away, the kids wanted to sell it right away. And the benefit of that is they got the full stepped up basis. We sold it within a couple of months from the time we listed it. So there were no capital gains at all. So they got the full benefit of the stepped up basis. So it's really a crucial tool in legacy planning. And a lot of people plan well and plan to pass, all of that bonanza onto the kids. But sometimes it doesn't go as smoothly. So kind of the model that we think of is your mom and dad. You've worked hard, you've saved up your money. You have a son John. And when the time comes, you get your halos and all the assets just go over to son John.
And usually the children don't know what to expect. I mean, people don't talk about their money.
Right.
They don't really disclose to their heirs what the plan is for whatever assets they have before they pass away. So
Yeah, so when we're with our trust attorney, a few years back, we get down to the point where it's like, who gets what? And so we're trying to make this detailed list. And we looked at her and said, do most people do this? And she says, nah, they say, just let the kids figure it out. Well, and that's what happens in a lot of cases, because really most people don't have just one child. Google says on average families have 2.8 children. All right. And my bad joke here is people will ask me, how do people have 0.8 child? And I really did look at my kids sometimes and say, son, you're not all there. So that was the 0.8. All right, back to the serious stuff. This is a more typical example. So mom and dad have 4 kids. They've got a vacation rental home, maybe here on Maui. They come here, they visit it. Kids are having a great time. Over time, one of them gets married, another one gets married. Maybe they buy more rental property, because we've definitely seen that happen. But the families all come together. They all enjoy it over time. And eventually you get grandchildren, which is a great thing. And the grandchildren start coming to the property. And so they're rotating time through, and life is very, very good. Except until daughter Sue gets divorced. And then mom and dad get their halos. Well, typical planning, like our trust attorney said, most of the kids don't know what's going to happen. And what we see in most cases is the oldest, the eldest, in this case, a son John, gets the trust, opens it up, and the trust is great. It says, divide up all the cash, all the stocks evenly, sell the house, and divide the proceeds from that evenly. However, a lot of times the kids don't agree on what they should do with that house, because if they're going to sell it, all of them have to agree to sell it. Even if the trust says to sell it, what we've been told is usually it doesn't give a deadline by when it has to be sold. So son John dutifully says, mom and dad, so we have to sell the house. Daughter Barbara here says, we had a lot of fun in that house. Besides, I think that is a really good investment. I think we ought to hang on to that and let it appreciate. And then maybe someday our kids can inherit that. So I'm against selling it. Son number 2 over here, Steve, says, hey, sell that puppy. I want to go to Las Vegas. So he wants the money to go play. Daughter Sue says, look, we did have a lot of fun in that house. I have an emotional attachment to that house. We just lost mom and dad. I got divorced. I can't take another loss. And then if this son passes along, what happens next is now maybe daughter number 1 is the trustee, and all of these kids are on title along with these kids. And so you can see it can just get more and more complicated. Another example would be mom and dad decide, kids, we're going to let you choose your inheritance. Another thing that happens with families today, used to, nobody really lived, on average, more than 75 miles from their hometown. Now, you've got kids on Oahu, Seattle, Texas, California, they're all over the place. And so a way to avoid kind of the hassle of all of the properties being divided up and trying to figure out who's going to do what is we see people now telling the kids, we're going to let you choose your inheritance. We're going to sell the big vacation property, and we're going to let you choose a piece of real estate for yourself. Now, we're still going to own it. If you're nice to us, we might let you use it. But it's something that you're going to inherit. And so each one of the kids gets to go out and pick a property. So if son 1 is still at home, maybe he picks something close to home. If daughter number One is living up in Seattle. Maybe she wants a ski cabin in Tahoe. Son number two, in our example, needs a place to live. So we buy him a condo in Vegas and rent it to him. So he's got a place to live. Daughter number two can buy her own replacement property. And so now, instead of fighting when they get to Thanksgiving, they're all talking about how great it is that they've got the properties that they want, and they can pass those on to their heirs. And just to bring this home a little bit, we have clients, my partner Dan has some clients over on Oahu where there were, I think, four heirs. They inherited a property. Now they are all in their late 60s, early 70s, and the only way they speak to each other and the only way they've spoken to each other for years is through their attorneys. So that's just not a good way to leave
So
it.
it wasn't planned that well. On the other hand, we have a success story of one of our clients who owned a commercial property on the mainland.
Mhm.
And she came and bought properties for her children to inherit here in Maui.
Right. And so she came into the office. She said, I want to buy 4 or 5 condos. I want them to be all in the same complex. And that way, every Thanksgiving, we can all come here. They can come over to my place, and it's just going to be so wonderful. And she was so excited, so enthusiastic. I mean, it was just, it made your heart swell. And now, when they pass away, each one of their kids has got their condo here on Maui, and they're getting around at Christmas and Thanksgiving talking about how wonderful it is to have that instead of having their attorneys talk to each other. So that's just another way to plan it. I hope this has been beneficial to you.
And if we missed any questions, you can contact us and we'd be happy to help with that.
And we'd be glad to set a time with you to talk about what your goals are, answer questions. I mean, no obligation. We're happy to do that. That's just the way we do business. We can take a look at what you've got. What's your equity position? What would your cash proceeds look like if you did want to exchange properties? Take a look at the performance. What we're finding is a lot of assets that people have, they're underperforming. And so it might be a good time in this market to be able to sell those and move on. Talk about strategies to get you to your goals, share opportunities to increase your wealth. We do this especially with our younger investors, how to grow their wealth, create an action plan. And, if you need an attorney or a CPA here on Maui, we can help you with that as well. So our mission is to create an exceptional real estate experience and real estate outcomes for all of us, you, your financial security, our associates, and of course, us. So we want to thank you for attending. We really appreciate that. Please send any questions that you have from this, if you didn't attend it live, to info@alohagroupmaui.com. That's info@alohagroupmaui.com. And keep your eyes open. We'll do updates from time to time whenever we see changes in the law or new strategies. And thank you for attending today.
Aloha.
Aloha.